Hey guys, thanks for joining us here at Salty Ginger Talk. If you're a returning listener, it's great to have you back. If you're new to the channel, we're really glad you joined us. Hope you like what you hear. We have a super interesting guest joining us today, Lane Kawaoka. He is a real estate syndicator. He has written a book called The Wealth Elevator. He hosts a podcast talking about his real estate syndication and investment strategy, also called The Wealth Elevator. Uh, Followed an interesting path, was an engineer coming out of college, saved up his money and started buying single family properties and has progressed through that real estate world. Has purchased and or owned over $2 billion worth of real estate. So, not from a wealthy family, not from an entrepreneurial family, a guy that learned his lessons by taking action and doing things. Super fortunate to have him on the show. Really glad he agreed to join us tonight. So, without further ado, let's bring Lane on to the podcast. All right, Lane, welcome to Salty Ginger Talk. We're glad to have you aboard.
Yeah, thanks for having me. Hello, everybody.
Yeah. So, we talked about it in the intro, but Lane is a guy who's traveled an interesting path. And we're going to hear all that tonight. So, started off as a civil engineer and is now into real estate and coaching and education. He's got a great podcast. He's written a book. He's syndicated real estate deals, and he'll explain to those of you that don't know what that means, what it actually means. So, we're super excited to have him on and we're just going to jump right into it. So, if you wouldn't mind, Lane, if you could just kind of start, brief background. I know where you went to school and all that, but assume our listeners don't, and kind of fill them in.
Yeah, I guess I call it the linear path. I was kind of taught to go to school, study hard, became an engineer. Most likely because in grade school I Googled which major made the most money without me having to go to more college. And I was could never figure out a foreign language thing. So what else other degree that doesn't need have a requirement for a foreign language other than engineering? So I let money guide my path, which isn't always the best thing, as they say, but hey, whatever. That's what I did, right? I'm a very pragmatic fellow, and graduated with an industrial engineering degree. Eventually got a master's in civil too, but started to work for the man. Started to work for a Fortune 50 transportation company as a construction supervisor, and made pretty good money with that. And then that, with my upbringing, was taught to be really frugal, never, don't buy things you don't need. When you go eat at a restaurant, if you're ever so lucky, don't buy a soft drink because you can just drink the damn tap water. Also, you know, save your money, right? And keep a freaking budget, right? I mean, basic stuff, but most people in this world don't do that, right? But I was lucky enough to have that upbringing. So very quickly after college, I started to save up money to buy a house to live in, which we're all brainwashed to think buy a house to live in and invest in the 401k, which two things I did. And then 2009, I bought my first house to live in, was never home because I was traveling all over for work as a construction supervisor, only home on like Saturday. And on a whim, I was like, this is kind of wasteful. I could make some freaking money by just renting this thing out. And I did. And I was homeless, kind of. And I just lived off the company dime. And I was like, well, this is super cool because I was, you know, making cash flow, right? And also saving, didn't have my tenant was paying down my mortgage effectively, right? And I was able to save like pretty much six figures every single year, which went to buying more and more rental properties. But that was 2009, and that was kind of the start of this journey that I've been on.
That's awesome. So, 2009 was right after the Great Recession. So, you had either the benefit or the foresight, probably a little bit of both, of buying when real estate had dipped in value. Is that correct statement?
Yeah, yeah. Sometimes it's good to be lucky, right? But I definitely was. I mean, I graduated in 2007, so I went through the experience of I thought that was smarter than everybody else and could day trade and do all that BS. Luckily for me, it came at like the worst time to do that type of stuff. right? So, everybody has a friend that thinks they're like a amazing gambler because they get lucky their first several times, which is often the worst thing that can happen. I had the opposite experience, right? So that kind of pushed me to kind of search and like, all right, this stock market stuff ain't for me. It's just too much stress. I don't understand it. I lose a lot of money, and I'm gonna try this rental real estate thing out. So that was kind of the path I went down.
So I love that. And one of the things, Lane, we talk about on Salty Ginger Talk is we try to point out when we're talking with folks for the listeners, kind of inflection points. So Lane's clearly a bright guy. He gets out of college, he tries the stock market and day trading and gets kind of kicked in the teeth. So does he keep doing it? Does he say, hey, I just haven't figured this out yet. I'm going to pour more and more money and effort into this? He does not. He looks at it and says, I got to find a different way to achieve the goals that I want, and he tries something new. Like we talk about all the time on the podcast, pivoting and trying something new when you get feedback is a good thing to do. So you're looking at a real world example. And as we get into this, you're going to see how successful Lane has been. And so from the beginnings that he's talking about here, it'll be great to show you where he's been to or where he's gotten to so far. So sorry to jump in with that, but we try to reinforce those things when our guests talk through them, Lane. So now you're in 2009. You've started buying real estate, and so talk a little bit before we jump into going forward. You talked about cash flow. What does cash flow mean in real estate investing versus appreciation? What's the difference?
Yeah, so cash flow is, basically your rents are coming in, right? That first rental I had that I bought for about 350,000 with $80,000 down payment. On a month-to-month basis, I think the rents were like 2,200 a month, and then the mortgage with the PITI, the interest and taxes was about 1,600. So initially I was like, well, I'm making like 500-600 bucks a month, right? Even with professional property management, which you gotta usually pay 10% to. I was like, this is easy money, right? There's a lot of beer money to a young 20-something-year-old kid. And that was cash flow right there. And there's a big debate whether one, cash flow is more important or, pure just net worth is more important. I'm generally on the side that net worth is more important than cash flow. But it's kind of interesting. It's kind of an esoteric conversation. Like sometimes cash flow is your peace of mind, right? If you have money coming in on a monthly recurring basis, like most of my clients, they want that $10,000 of passive cash flow every single month. More so they want that feeling of it, of regeneration every single month. But you get there by having a freaking net worth of above $2 to $4 million. There's no changing that. And so, it's kind of switched back and forth. In my earlier days, it was all about cash flow because I was desperate to leave that engineering job that I didn't really like.
Got it. So that's a great conversation point there. So a lot of people, and I've heard you, so you've talked a couple of times already about following the beaten path. Work hard, go to college, buy a house, invest in your 401k, get a job with a company. Like a lot of those things are not things you're doing now. Is that true statement?
Yeah, I mean, and we'll kind of get there, next part of my journey. But like what I started to realize is that the way that we're all taught to do things by our parents or what the guy in the cubicle next to you is doing it is vastly different than what the quiet wealthy are doing in terms of where they're investing. Was just listening to an article the other day from JP Morgan, which is, Chase private wealth clients, the top 200 families. Um, I don't have it on my desktop anymore, but essentially if I remember it, they only about like 20-25% of their net worth is in stocks, bonds, mutual funds, that type of stuff. But for some reason, the average Joe, that's entirely what they say you're supposed to put all your stuff in. And the reason why is there's high fees, and where traditional Wall Street can take your money and the sort of a financial planner can get his share. But when you look at, what is the makeup of wealthy families, it's a lot of it's private equity, real estate, in the form of syndications or direct ownership of real estate. It's more of these like essentially they're cutting out the middleman of all these financial products and going directly to the source. And then by doing that, they also get these sweet tax benefits that they pay little to no in taxes. And then they also use life insurance in a very different way than your scammy friend who ran the MLM marketing scheme with the whole life insurance configured it, right? And like when you combo all these things together, it's a very powerful formula that I wrote the book Wealth Elevator to kind of go walk people through this trifecta of strategies that I uncovered that is very implementable by the average Joe out there. Unfortunately, it's complete opposite in what we're all taught and what our parents taught us.
Right. Yeah, I love that. And I'm glad that you're on here talking about it so you can educate our listeners. But you said something there that you discovered. So this was new to you. You figured all this out as an adult through trial and error, did you not?
Yeah, I mean, so fast forward, after I bought that first rental 09, I bought a duplex in Seattle. So this is where I got a little bit smarter of like, more investor wise, like what to buy. That first property was super cool, class A, that because that's what I wanted to live in, right?
Hmm.
I bet you live in a nice place. Bet the listeners like to live in a nice place. But typically their best cash flowing assets, your rental stock, isn't in the best areas. I mean, certainly it shouldn't be in the slumlords. You shouldn't be a slumlord either, but they're not in, your sexy places to live, like Seattle, right? And so my second purchase, my duplex in Seattle was in South Seattle, which is a little bit more seedier area, a little bit better rental value ratios, where the rental value ratio is you take the monthly rental price divided by the purchase price, and you're looking for something but 1% or higher. A lot of these places like in California, Seattle, Hawaii, what we call primary markets, cool, sexy places to live that don't make the best markets to invest in for cash flow, have horrible rent to value ratios, right? Like a place in the ghetto in LA for $400,000 you probably rent that out for $2,000 a month. So 2,000 divided by 400 grand is 0.5%. No bueno, doesn't work. Where in 2013, after I had a few units in Seattle, I was looking to buy more, obviously, right? Because this stuff was working. And I was like, wow, I was getting super motivated. I was, educating myself a lot, talking to a lot of people. And about this time too, I was kind of becoming a horrible employee. I, wasn't listening too much. And, because I made more, I was making more than my boss, at the time. And then, but I had to make a pivot, right? As you said earlier, smart people, they don't make the same mistakes again. And, at that time, the prices were coming up and the deals just weren't working. So I had to go buy properties in more flyover states or what we call secondary and tertiary markets. So I bought, I think like 9 or 10 in Pennsylvania, Indianapolis, Birmingham, and Atlanta. So not the sexiest of places, but good rent to value ratio numbers. I think, the first one I bought in Birmingham was $80,000 purchase price and it rented for $900 a month.
Nice. Yeah.
Yeah.
So you're
Yeah.
above
But
your
it was easy
1%.
back then. Any
Yeah.
idiot could have done it back then. Today to buy that same thing probably costs 140 grand, rents for 1,000. But, just this is kind of, where I walked through in 2015, I had 11 of these rental properties throughout the country, all remote, all with professional property management. And I was still working my engineering job, kind of hiding out.
So now you're up to 2015. Is it 11 properties or is it 11 doors?
Both.
Yeah.
Yeah. Yeah.
So these are single family, multifamily, but nothing commercial at this point.
Yeah. And that was kind of on, I don't know. I like to say it's on purpose, but I think it's maybe luck too again. But we tell people, especially if they're a higher income earner, that they're going to graduate out of these little silly single family homes quickly. So maybe you don't want to buy a duplex, triplex, or quad or something bigger because the only people you sell that stuff are cheapskate investors. Ideally, when you exit it, you want to sell it to an emotional buyer who loves the cabinets and cupboards. So, and that's a single family home. So that's kind of what made my transition a little bit better, kind of knowing what I know now, kind of helping people get started on this first floor of the wealth elevator, which I guess I'll define, right? Like when I first started, in my book, The Wealth Elevator, I go through these chapters, right? These paradigms, these part of the building, right? The basement level of the wealth elevator, I think, is predicated on a lot of people out there who just don't have any net worth. They don't make at least $50,000 a year. I think people have heard of like Dave Ramsey, Susie Orman, a great content these guys put out, right? Good financial advice. Unfortunately, it's for people in the basement level. Now, when people, you've heard my story, I kind of started on that first floor of the wealth elevator. I didn't really have any net worth. I also, didn't have too much student loans itself, but I had a good paying job, professional salary. So I was kind of luckily started on this first floor of the wealth elevator. And to me, on that level, the name of the game is buying rental properties, essentially going around the monopoly board, buy little rental properties. And then the transition out around 2015 was my transition going from the first floor to the second floor. As the saying is, what got you here isn't going to get you there. No different when I, was buying properties in Seattle where the rent to value ratios didn't work. And then I went out of state. Same transition period, going from the first floor to the second floor of the wealth elevator. With these 11 rentals, they're good, I guess. Who wouldn't complain about a few $100s of passive cash flow per property and, maybe $3,000 of passive cash flow a month. But every, at least once or twice a year, I'd have a big major eviction where the tenant would just trash the property, $25,000 repair bill. Not to mention all the quarterly headaches, like tree falling on the house, a flood in this basement. And, I had professional property manager do all this BS for me, right? But, with 11 rental properties, it starts to get to a bit of a charge. And all for what? $3,000 of passive cash flow a month. Again, most of my clients are looking for 10 grand or more. So that means I would have needed 30 rental properties. And then now you're seeing how this becomes quickly unscalable. And not to mention at that point, when you become an accredited investor, $1 million net worth or greater, you're actually a target to getting sued at that point. To be honest, I'm not giving any tax or legal advice in my talk today, but who really wants to sue you when you're broke? Right. But when you're an accredited investor, the game changes a little bit. And most of my clients are accredited investors, and you want to get out of rental property ownership at that point and go to more of a passive investor in larger deals. But that's kind of takes us up to maybe about 2015, 16.
Yeah, it's funny you talk about the accredited investors. So, my day job, real job, I'm the CEO of a company that owns and operates grocery stores in Chicago. And you'd be shocked how many people magically slip and fall where there's no camera. And oh, I hurt my neck and I can't work and et cetera, et cetera. And you're paying these nuisance settlements to people because it's cheaper to pay the nuisance settlement than it is to litigate the thing out to completion, even though you know that in the majority of cases, these people didn't really actually slip and fall and get hurt. But, they're professional victims. And
Yeah. They're trying to get the insurance money at the very least, right?
yeah, yep, exactly. Exactly. So, yeah, you wind up, and I have a similar background to you where I started, my dad sold magazines and my mom was a stay-at-home mom. So like I started with nothing and have built, my wife and I have built what we've built um together. And that's why it's so good for our audience to hear from various people like how they did it, because there's no one path, but people have discovered lots of different ways. So now you've got these 11 properties. You've got all the pain in the ass stuff that happens from owning 11 properties. You got the cash flow coming in, but a pipe bursts, someone stops paying their rent and trashes your place, and you got to spend a bunch of money to turn it over. Where do you go at that point to kind of continue the journey, but kind of evolve your approach?
Yeah. So I didn't really have too many mentors, right? Like, who owns more than a handful of rental properties, especially in their I think it was even in my still my 20s, maybe early 30s at that point. And there's a joke, and you'll I think talking with me, you'll kind of get my dry humor, but single family homes were working. What should I do? Maybe buy multifamily, multiple homes, right? So like, I eventually kind of followed like the slippery slope to like buying, apartments and things like that. So, I think this was kind of the part where, prior to this, I mean, I'm an introvert. I don't really, like to talk to people specifically, right? But when it comes to like investing and like financial freedom, I really like to do it, you know. Um, I at this point I had to kind of get out of my shell and see what other cats were doing out there, but more specifically what accredited investors were doing. I was no longer able to talk money with family and friends, and even coworkers, even older coworkers. What the heck am I going to learn from them? The wrong way to do it? To stay in the cubicle land for 30, 40 years? Like those are like the absolute worst people to listen to, right?
Mm,
One of the things I learned very early on was you only take financial advice from people who are financially free. Those aren't the financial planners out there. They just sell you commission products, right?
yep.
But it's those quiet guys that own a lot of rental properties, have a net worth of multiple millions, are the guys you have to kind of seek out. So I kind of inadvertently went on this mission to kind of find these types of people. And I didn't really understand what I was doing, but I would, have beers with these, more experienced investors, older investors that were maybe half a step beyond me. And this is kind of where I started to, you know, had a lot of ideas. Not all of them were good, but the consistent thing that kept coming up was this trifecta that we put in the Wealth Elevator book of first investing in good deals where there's a hard asset such as real estate with a value add plan. And second, using those passive activity losses you get from those real estate deals to pay a heck of a lot less taxes or none legally, and then running your family finances through an infinite banking plan, right? This trifecta of strategies was very consistent. It changes a little bit based on what floor of the wealth elevator you are, and I kind of detailed that in a book in a cool chart because I'm an engineer, right? I think in charts and flow charts, but this is sort of the early stages, and this is where I got all of it from, right? Was just talking to a lot of people and asking why did they do that? And then you also started to realize a lot of people had their opinions on like, why is that the case? Why is it that financial planners, it's kind of like the Wizard of Oz, right? Like once you figure this all out, and you go back and you realize the Wizard of Oz is not real. Like why do they want us to invest in the 401k and max it out? Oh, now it makes a lot of sense because then we'll never freaking retire
Mm.
because we'll just keep plowing money into that damn thing where Wall Street gets all the returns off of us taking on all the risk. Makes total sense. And you said earlier, right? We're going to talk about like a lot of these strategies I talk about are very simple. Well, we don't want everybody to do it. Then who would get our coffee every day? Who would build our bridges? Who would be doctors for us? Right? Who would be the good construction superintendent? I mean, that's someone's got to do it, right? But I think like to do this stuff, you got to get off the beaten path and surround yourself with the right community, which is kind of what we specialize in. We do a lot of events, make people feel comfortable and build a tribe around them because it is very, going against the grain, this type of alternative finance ideas. But yeah, that's essentially the secret sauce that I discovered back then. And I kind of saw that the thing that really got me was, just like seeing people with handful of rental properties. It's like, well, that guy's not super smart. I can do it too, right? I saw these guys with multiple $1 million net worth, and a lot of these guys were well respected in their professions, right? Made multiple six figures at their jobs, but they weren't like Ivy League quants investing people. They were just regular people, you know. Um, and they weren't business owners too, a lot of them, right? Like, I mean, I think you talked about you kind of grew up in a family business. That's a real business. Real estate investing is not a real business to me. It's about the easiest business that you can get into. You're just renting out a silly little box to people. It is capital intensive. You need money to get started in it, but it is one of the easiest businesses. So for me, it was a smooth transition from not being a true entrepreneur, coming from an entrepreneur family myself.
So sorry, your family was entrepreneurial?
Evans, no,
That's what I was going to say. I
no,
thought I heard, I must have heard it wrong.
no. Yeah, I mean, I remember when I was like 7 or 8, I was like, I think my mom was like, "Oh, not everybody owns their house. We're super lucky. You should have gratitude." And I'm like, "Well, why don't we rent our house to some other people, make some money?" She's like, "Oh no, you don't want to do that. They'll screw up your house." And then she squashed the dream that, the fire that only came back, what, 20 years later, right? But um yeah, I mean, I think that's maybe something I think back, like, I guess with my kids, give them exposure to these types of alternative ideas and let them choose themselves. Where, at that point, she didn't know what she was doing, right? But I mean, it would have been cool if I had a rich uncle show me the ropes earlier on.
Yeah, and so you've touched on a couple of things I just want to illustrate for the listeners here. So Lane's an introvert. He's here doing a podcast with us, but he said he said his own words is I don't really like talking to people a whole bunch. However, he knows that it's something that drives his business, and he has found something that makes him want to work with other people, which is teaching wealth creation and real estate investing and learning how to build generational wealth for you and your family. So that gets him out of his shell a little bit. That gets him, and he had to do the hard swallow and do some
Yeah.
stuff that wasn't super interesting to him or super exciting to him to begin with. And then, you've got a guy here who, not for nothing, but most people don't get a single degree, but a second degree in our society, right, wrong, or indifferent. I would argue many times wrong, places a premium on a college education. I always go back to Goodwill Hunting, where he says, 20 years from now, you're going to wake up and realize you dropped 200 grand on education you could have got for $1.50 in late fees at the library, you know? And so he's thinking differently. He's thinking as a contrarian and saying, I don't want to do what you're telling me to do. This doesn't make sense to me. So I'm not just going to eat the stuff I'm being fed by society, and I'm going to investigate on my own and make my own decisions. So powerful stuff there. May not seem like much,
Yeah.
but powerful stuff there. So
Yeah, good takeaways. I mean, there's a book out there that kind of reminds me of like Gretchen Rubin. I forgot what the book is called, but I think it's like the four tendencies. There's kind of four profiles out there. Um, I'm either the the total rebellion person, right? And I think maybe that was part of it. Like my parents, they did it all the right way. You're supposed to do it, right?
mm,
Go to school, get a doctorate degree, max out the 401k, see how that worked, right? I mean, it took them so damn long to get to a decent level. And I was like, yeah, I'll do it a different way. And so luckily they did it the wrong way. It followed the wrong way. Um, which is kind of interesting because sometimes I have clients where they want to get their kids involved, right? And I'm like, well, don't push too hard because they just may be a rebellious kind of personality. But in that book, there's also a profile where you're just questioner, right? And I think that's what truthfully I am. I'm a questioner. I'm like, why invest in the 401k, right? Like, why would I want to make 7 to 8% and it goes up and down, up and down? I get no tax benefits from it. Makes no sense to me, like who cares if I get a match? Who cares, right? Like I can make a lot more doing this simple buy and hold rental real estate, right? Um, and then there's obviously the other profiles I can't remember. I mean, who cares about the other profiles? They're the ones that just comply and follow directions. They never make changes in the world anyway, right? But you need them to be part of society, have society go, right? But I think it's important for people to understand which profile they are, right? If they're rebellious type, there's strategies that you can do to kind of set yourself up for success. there's the questioner, right? Like, why not eat that sandwich or why not eat that cookie? You just have to kind of know where you're at. And that's kind of like my book, The Wealth Elevator, is like the first step. Figure out which freaking floor of the wealth elevator you're on now, and then go from there. As opposed to if you don't know where you're at, you don't know where you're going concept, right? Like you might be broke and the wealth elevator may not even apply to you,
Hmm.
right? Or you may be $2.5 million net worth and cool, plug you right into the second floor of the wealth elevator and off and rolling.
Yep. Yeah. So I love the thought process. I have always been kind of a contrarian by nature. And I use COVID as an example. So, when they started coming out with all of these restrictions, I was always asking, well, why? Well, like, okay, face masks. Why? Is there evidence that face masks work? And no one ever had any evidence. Social distancing. Is there proof that staying 6 feet apart helps? Like, I don't know. Like, I haven't seen any of it. And it was shocking to me how many people through fear were just willing to accept it. Like, oh, they said I'll be safe if I do this, so everyone needs to do it. Well, how do you know you'll be safe? Like, they told you that, but did you ever ask, like, prove it? Show me? Make it make sense? And I've been that way my whole life. Now, that can get you in trouble sometimes because there is some advice, that's worth like mainstream thought process is good in some instances. So it's not good just to be a contrarian, but you do want to understand why you're doing what you're doing so you can agree that it's a good thing to do.
Yeah, yeah, and maybe I'll bring that a little bit more home. Like for I'm in an angel investing group, and this line comes up multiple times where it's good to have a disruptor type of company or a tool, but the the sage line it always is, well, why hasn't anybody done this in the first place, right? Like why are there no successful people who took this right path through the valley? Well, is it because there's quicksand everywhere and everybody dies? Or, bringing it back to a more of a business setting, is it because there's no viable customers? No one's willing to pay for that thing when you start to go down that line, right? So yeah, like you're saying, it can hurt you by being a true disruptor or contrarian or zigging when everybody's zagging. But I mean, I think it's much more of a fun life though, too.
I agree with you. I always say I would rather, and it's not my saying, but I heard it and it stuck with me when I was a kid. I would rather die on my feet than live on my knees. And I kind of
Yeah.
feel like that the mainstream just follow the path is kind of living on your knees. That's the way I've always felt about it, at least. But that's just me. I'm not judging anybody. I just know it didn't work for me. That much I know. So at this point, so were you still single at this point?
I think I was. I think I was. I did get married eventually. So like, I mean, in this whole time, I mean, I'm just plowing away money to buying more rental properties, right? That like, and from a basic level, that's essentially part of the wealth building game. You got to just save your freaking money, and part of that is basic budgeting. So most of my clients, are accredited investors, but they're able to save 50, $100,000 a year at least. Some of them are able to save multiple $100,000 chunks every single year. I always tell, like, I run into more of my clients are more of like the ultra savers. The people are just way too freaking conservative. And we often give them the book Die with Zero. If you guys have read that book by Bill Perkins. He was actually on my podcast, really super down to earth guy. Was able to ask some of my more specific questions that I selfishly wanted to ask him. But a lot of our folks have way too much money because they saved the darnest over the years, and they just are a little bit late to the game on transferring their money to experiences. Because at the end of the day, that's what life is for, right? You can't take money to the grave. Um, but that's kind of where you know I guess most of my clients are also in their late 40s, 50s, but from time to time I'll get somebody my age. Definitely not as far as where I am, for sure, right? Because they're not a business owner and they didn't start syndicating big deals. But I still tell them like, look, if you're, let me give some real data points here. So if you're in your, let's say you're 30 years old, which is not entirely super young, but some of these guys have $1 million net worth because they get paid $200,000 right out of college, especially in tech. And especially when you're a guy, you're a geek, you tend to get married late, go figure, So you just stacking your money up, and they're saving like $120,000 a year. And I tell them like, look, man, if you're already to like $1.5 million in your early 30s, you're ahead of the curve, even for our standards, the wealth elevator community standards. Most people I would say are at $2 million in their 40s, right? So if you kind of follow that trajectory, that person is well on its way there. And I tell that avatar, the younger guy who's already at one mil, like, you just save 50 grand a year, dude, and relax.
Have a
Go
little fun.
get yourself a girlfriend, or whatever you're into these days. Go on a vacation, instead of being like these diehard max out your 401k because that's the only thing that gives you any type of you know, significance in life, which admittedly that was me, right? I just like to save money because that made me feel special,
Sure. Yeah.
weirdly enough. But that's, for people like, I think that's kind of the people that I see a lot is the people that oversave. But when you're able to apply the deals, the taxes, internet banking, and this trifecta, you don't really have to do much. You're always swimming in the right way, in a way. Where most
Yep.
people are just 401k, blah, splashing in the water, not going anywhere, right? Spending a lot of calories, not going anywhere, almost drowning, right? Like if you are able to swim the right way and apply this format, high speed, low drag, now you can kind of take your foot off the pedal off of pure saving. They're deferring, what do they call it? The deferring lifestyle.
Yeah. Yeah. Look, delayed gratification, right? There's value in learning delayed gratification, whether it be mental well-being, physical well-being, financial well-being. There's value in learning that you don't have to expand your life simply because your income expands, or your life doesn't have to get bigger because you have access to whatever vice you want to insert here. And delaying that gratification down the road typically works like compound interest. You get much more gratification when you get to it, but to your point, life is like, I'm 53 and it occurred to me, I don't know, 8, 9 years ago. It turns out I'm not actually going to live forever like I thought I was gonna when I was younger.
Yeah.
And like, it was shocking to me that that wasn't true in my mind. Like I had an infinite runway.
Nah, you better check that again. I think you'll live forever.
I thought it was true. It's not. And the people closest to me became much more important to me at that point because I realized that the most important things in life are experiences and relationships. Now, that doesn't mean devil may care, throw caution to the wind, have no plan. It's better to plan like you're going to live forever, but act like you're not. And there's a balance between those two things.
Yeah, and that's kind of where I've seen this happen many times. Like I said, most of the people that we work with initially are those oversavers, right? The delay gratification people. But it's I think part of why people bring me on is like to essentially at the end of the day, I mean, numbers and money is one thing, but essentially at the end of the day, from a mindset perspective, get them all that hustle culture mindset and into, we're gonna be okay and let's enjoy things kind of mindset. And what I think it's very similar to is like, when you're in an airplane and they give you that announcement, right? To put your mask on first, right? Take care of yourself first. I think that is very true financially, right? Like get yourself to at least a couple $1 million net worth first. Get your own oxygen mask on. Get your finances in order first. Invest it in the right things, ideally, not the 401k stuff. But you know, you got to get that stuff first. And you may have to be selfish in doing that type of stuff. But there comes an inflection point where people, and some people move through it pretty smoothly. I think maybe I did in a way, right? Like I was, I had a few rental properties and I was like feeling good about myself, right? At that point, the edge was somewhat coming off at that point. Whereas unfortunately, some people they get to be like 60 years old with $5 million net worth and still a cheapo, and they don't really have any friends. They're cheapo, they're stingy. Nobody wants to hang out with them. They're not fun, right? They're not fun because in part, they don't exchange money for experiences with people or memories. Um, but I think like it's kind of one of these things you hold on to like the what is it, the badger who likes to hold on to shiny objects unless they feel safe enough, they don't let go of what the ideals that is kind of holding them back. But this is I don't like the monk who has no stresses in life. That's not an
Mm.
applicable person, right? Like that guy's broke. He needs to stop meditating and go get a job and then invest that money and then go and you know, do all the things that we say, and then he can come back to us and says he's found enlightenment, right? Like that's the more hard ass approach that I apply it. But not all my clients are like that. But that's just me overlaying my personal values on top of this. But going back to the concept of delaying gratification, you've heard of that mushroom or that not the mushroom. I'm talking about mushrooms now, but the marshmallow tests, right?
I
The
have.
they did, yeah, they did this psychology thing where they put a bunch of kids in a room and they say, well, you can have one marshmallow now, not mushrooms, one marshmallow, and or you can wait a while. We're not gonna tell you how long it's gonna be, and we'll give you two. So the reason why I don't like this study, the way it was done or how it applies to us, is that it was very binary. It's either I get one or two, and they never really told you how freaking long you had to wait.
Mm.
I mean, that's that's setting the kids up. It sets adults up, and in a way, we're all kind of in the same situation, right? We're all taught to not eat our nut. Don't eat the marshmallow, and you will have a good retirement at the end, right? But it's all what I've discovered is like when you do things the right way, you're able to get where you need to be in a third amount of time. So hit financial independence, possibly maybe even in your 30s if you start out early. Or if you're already in your 40s, maybe well before your 50th, you know? It's very possible. Um, I mean, maybe even less than 10 years, depending on where you're at. Maybe in less than 5. Some people
Mm.
maybe are already there, we've seen. They just need to convert their money, their net worth to cash flow. But that's kind of where, like, going back to the marshmallow test, it's like in reality, it's like if they would have told the kids, hey, we'll give you two marshmallows, you just have to wait 2.7 freaking minutes. Like, even my daughter can do that, right? Like, if you tell them a certain timeline, the problem is there's no timeline given. So it's going to drive people bonkers, and it drives adults bonkers with this real life example.
I would have negotiated. I just know myself. I would have been negotiating in the room. Like, what if I wait 5 minutes? Can I get three marshmallows? That's I just I would
Yeah,
have
I mean
been
that's how you do it, right? At least get the time component of the thing, right?
exactly.
But but yeah, unless we have like models around us or have a better procedure of doing this, you're gonna be waiting 60 years to maybe get your two marshmallows. That's
Yeah,
not a good deal. I wouldn't. I would just eat my marshmallow. Who wouldn't, right?
exactly. Exactly. No, I look, those are we talk a lot about experiments because we try when we give tips and or action steps on our podcast. We try to use science-backed stuff because, like, it'd be a little hypocritical of me to say, here's what you should do without saying, here's the proof of why you should do it, you know? And so there was an experiment at Yale University called the Milgram experiment. Have you ever heard of that? So super interesting. So the one person in the experiment is the person administering this test. So you've got an actor who's acting like a scientist, and then you've got an actor who's acting like a person who's answering questions. Then you've got the subject of the actual experiment, who is the person that's administering the test. So the scientist says, you need to ask this person questions. If they get the questions wrong, reach over to that machine in front of you and give them an electric shock. And every time they get the question wrong, the level of the electricity goes up. Now, there's no actual electricity. The scientist is not a scientist, and the person that's getting the questions wrong on purpose is not actually getting shocked. But there's a wall separating them. And the whole point is, how far will people go if a person who's an authority figure tells them to keep going, even when they know it's wrong? So, like, the voltage on this stuff went up to like 500 volts, stuff that would kill a person. And as they're giving the fake shocks, the person on the other side of the wall is going, "Oh, please stop. I can't take it anymore. You're killing me." And the person was conflicted. The person giving the test was conflicted. They turn to look at the scientists and go, "Hey, this doesn't seem right." And all the scientists would say is, "You're required to complete the experiment." 65% of the people went all the way to voltage that would have killed somebody. And you talking about uh, following the path, blindly following the path because people told you to follow the path. Like, there's a lot of that in human nature. And it would be good for all of us to ask questions, like even on the marshmallow experiment. Like, why do we only have two choices? There's got to be another way to do this. What's the time constraint? How many marshmallows total are in play here? You know? And if you don't ask those questions, you're going to keep getting the same results that you've gotten your entire life.
Yeah, yeah. I think my takeaway of that example you gave is, in that situation, they didn't have any peer group or, like I guess like we're social creatures. So I think that's what I think works against a lot of people is they have their peers in the cubicle next to them and they're doing their company match, 401k, doing their 60/40 mutual fund, whatever. And they're not buying a rental property because everybody says that's dangerous, a pain in the butt, and a lot of work. And that's the prevailing incumbent idea out there, and that's kind of why you know once a year we do. Most of our investors are pretty busy, especially with family and stuff like that, and their jobs. But we bring them to Hawaii for like a few day retreat, and we get them around the ethos. Essentially, drink the Kool-Aid, right? Like you have a lot of other people asking the same questions, like why not take money out of my paid off house to redeploy it here, right? I mean, obviously that comes with risks, right? But why not arbitrage things here? Why not invest in investments that make a lot of prudent sense that powers, that caters towards blue collar Americans, that isn't a growing demand, blah, 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 blah. You know, it's just they don't have people around doing it. But when you can cook the guest list with people who are all at least going in the same direction, at least you can kind of set the stage more of a neutral so that now they can actually talk, the whys with each other and build strategy as opposed to just always constantly going uphill. Sadly, it's kind of like, people who don't go to college or even people who don't get work, right? Like there's some cultures that would rather just sit at the beach, do nothing all day because that's a cultural thing.
Mm.
And it is sad. Not to say that that's wrong. I mean, I don't know. Maybe I'm the wrong one, I guess. But you are a product of your community. At the end of the day, you regress to the mean, and I think that's what's kind of hard for some people is that very quietly they want to do something different. They want to but they don't want to take the chance because they've never taken a chance in their life ever. Um, that was kind of where I got lucky, right? Like I kind of just haphazardly fell into it and the shit worked. So I kept doing more and more of it, but I wouldn't dare tell anybody else about it because they would have thought I was crazy for owning more than two rental properties. Go figure. And now, we've acquired over $2.1 billion of deals. It's kind of gone bonkers at this point, but it just would have taken, if I was somebody who was thinking what somebody was thinking about me or being afraid to fail, then probably would have never gotten started. And unfortunately, that's what stops people at zero.
Yeah, well, and like you talked about earlier, your first foray was day trading and it went terribly. So you had to find something different because that wasn't going to work, you know? So that's a good segue, though, to syndication. So my bet is a lot of our listeners don't know what a syndicated real estate deal is. You've done lots of them. If you wouldn't mind, can you explain what a syndicated real estate deal is and then maybe talk about the first one that you did and how you did it and what you learned from it?
Yeah, so syndication is just a legal form of pulling money together. It's kind of like, like a stock in a way, right? But when you do start to do this, there's a lot of, securities laws and stuff like that. But essentially the way it works is the analogy we like to use is like an airplane. In the cockpit of an airplane, you have the general partners, who are also called sponsors, operators, a lot of different names for the same thing. But these are the guys who fly in the airplane, right? Or in a real estate deal, find the apartment, manage it, get a property manager, get the lending in their name, take on the legal risks, pretty much do everything. And then the people and coach are the investors, and they invest their money, but they sit back and are passive. And that's the cool thing too, is on their behalf, they're LPs, right? No different than like, you probably invest in AT&T, right? You know how many lawsuits AT&T is going through on any day, but you're
Sure.
not really touched by any of that. This is the beauty of being an LP. But you get all the nice tax benefits and equity upside to being a common equity investor, but none of the management headaches either. So what this opens up is this opportunity for investors to go into multiple of these proverbial airplanes and have a general partnership manage each of these assets. So but first I didn't really get it, right? I was like, well, let me just invest in this one apartment, this apartment, that apartment. But then when I started to meet other investors that rent dozens and dozens of these, I was like, oh, I get it. Like it's like we're dollar cost averaging, building a
Mm.
portfolio of directly investing in a lot of these deals. And then I started to realize like, oh, this is how Wall Street and institutions and wealthy people just mop shop with everybody else out there. They get direct access to these types of deals where like REITs, everybody's heard of REITs, right? But the problem with REITs is there's like a gazillion middlemen in those things, and barely anything goes to the investors at the end
Mm.
of the day. So this is kind of the way of cutting out the middlemen, getting direct access. But there is dangers, you got to find the right people. And that was kind of where I found myself in 2016, getting involved, building networks of other investors, kind of corroborate who are the people I should invest 50, 100 grand at a time with. And, on the one hand, you look at the people running the deal. On the other hand, you look at the numbers, and there's kind of two ways of looking at it, the jockey and the horse. I'm actually working on a book right now, kind of, going into the deep due diligence. We already have a e-course on it, which, if people get a hold of you and reach out through email, we can get them free access to that, no problem. But um, you know, that's the problem, right? How do I do due diligence on these deals where, there's no review sites on these people, right? But what I was lucky enough was I kind of found the honey hole in terms of the community, the people, right? Like there was networks of passive investors. And I think that was powerful for me, and why I kind of created our own ecosystem of purely passive accredited investors is, that's what really I think makes things a lot safer when investors aren't out there and just blindly investing with whoever random person on the internet. They've got a sounding board of other investors. But yeah, like my first 15 deals, I probably should have not invested in a few of them, right? Like one out of five. But at the time, that was the only people I had access to, right? Like people who are just fake it till you make it operators on their first dozen deals, or maybe $500 million, under $500 million of assets owned. Those are the people that I would be willing to talk to, little old me, right? But when we first got it started, I was just trying to invest passively at first. And then, like I said, things didn't go as best as I planned. So I was like, and I started was like, you know what? These guys aren't super smart. A lot of these guys have never even owned single family homes. Why the hell are they doing it? Right. Because you got a lot of these programs that teach people how to be an overnight, syndicator, general partner out there. But, and then I was like, well, let me just do this myself. Because if I'm going to deploy serious money, and I was putting more than half, maybe even more of my net worth into this stuff. Eventually I sold off all the single family homes, right? And kind of went all in. But I was like, I'm kind of in a way all in on this stuff. So I better put in the effort and work to do my due diligence. And part of that is like, damn it, I don't trust any of these suckers. I'm gonna do this myself attitude. So that was I guess maybe the situation there is things didn't work out the best. So that pushed me into kind of doing it myself, driving on my own, right? And that was kind of where we started to syndicate smaller class C properties, so like the junker properties, right? The ones that we could get access to. And a lot of those properties, it's just a lot of headaches running them. Collections are like 80%, so like 2 out of 10 people don't pay. We made a lot of money doing that because able to implement the business plan, but eventually just moved up to nicer assets, a little bit bigger too. But that was kind of the early stages, I would say. So as much more problems with people than 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 the actual assets, I would say. Because that was still a good time, right? Like the market correction didn't happen until 2022, 23.
Yep. So you were a passive investor. Talk a little bit about, because you've referenced it a couple times, that it didn't go great your your first couple experiences. How did you learn from that, and how did you apply those learnings on future deals? Because clearly it's gone well since then. And certainly doesn't sound like it was fire and brimstone, but it could have been better, right?
Yeah, I mean, luckily it was good times, right? Like from 2010 to 2022, we're kind of investing in a good, slightly improving market, right? In that time. But I guess coming down to it, I mean, these investments are pretty forgiving, right? Like you're investing in projects that are making cash flow, and the business plans aren't really audacious. You're maybe putting in $5,000, $6,000 of renovations into every unit, new flooring, new appliances, new paint job, and you're bumping the rents up $100. Sometimes you're not doing anything and you're bumping the rents, right? Like it's pretty forgiving. And a lot of times when it's like that, the only problems that happen is because people are just idiots running the deal. Um, or they're new at it, right? Too.
Yeah.
I mean, that's part of the deal. And it was just like I got just to a point where you started to realize, like, maybe I'll just do this myself. Or at that point, you start to realize who are the good operators around. And hey, let me just work with you. You and me take down this next deal because all these other people were just dead weight around here.
Yep.
What one of the things I found, and I might be wrong with this too, but like try to work with people who's come from a Fortune 50 corporate background.
Yeah.
And maybe call I'm not a huge fan of college educations, but I think it does show that you've been able to apply yourself and stick with something to the end. Um, I certainly think that there's probably some even more successful people out there who don't have college educations that have a lot more, grit, but you also have a bunch of deadbeats too, right? That don't have college educations that haven't proven themselves in life. Then the problem is you just don't know which subsection they're coming from.
Right.
But at least working with somebody who's, I mean, just speaking for myself, working for a Fortune 50 company, there are a lot of things that I learned just managing people, right? Being a supervisor of people, managing budgets, project management, like it helps me a lot in work. And it also helps me understand why bigger companies do things like SAP accounting, different accounting codes, just for example. Why do they keep track of certain things? And I may not do it in my company because it doesn't warrant it, but the the experience is there and I can use it in my own company today. But some people just have never worked in corporate before, which I think is a bit of a mistake. One thing I keep hearing coming out, you mentioned your second gen business owner. One thing I hear a lot from family businesses, you never give up the reins to your offspring to take over the company unless they've been promoted a couple of times. And part of that is, if you notice, they're not working for the family business the first go around.
Yep.
They got to go screw up on somebody else's dime or go learn elsewhere.
Exactly. Yeah, and I've been in the corporate. I worked in the grocery industry. I've been in the grocery industry for 30 years, but I worked for Albertsons, and that was they were a Fortune 50 at the time I was with them. And then I worked for one of the 10 largest private companies in the country. And that's where I really kind of started taking over big stuff. I just remember, I was responsible for P&L that was about $450 million in revenue a week. And I remember thinking, man, really? Like, really? I'm
Yeah.
responsible? Me? You guys know what you're doing here, right?
Because you said your kids are older, right?
Yeah, my kids are
they're
grown now.
they're
Yeah.
not in they're not in the family business.
No,
Yeah. But if they were, you probably have them go work for some other company, some other grocery store first, right? Like,
they already have. It's funny because I
yeah.
know I worked for and with a guy here in Cleveland for a while, and they were, what were they? He was fifth generation, and that was the rule. The rule was you don't start working here. You go work somewhere else and figure out how the world works, and then you come back here and you can start doing stuff here, but you're not going to be in charge here on purpose for the reasons you just said.
Yeah, yeah. Plus, you don't want to piss your employees off, right? To nepotism. But yeah, like you want to learn, you want to take the business practices and lessons from somewhere else and bring them back home is the idea. But that's essentially what I did. I worked for a big company, kind of got, you know, kind of maybe I got some bad habits working for this company from a leadership perspective. Um, and I can tell you, I definitely did not come from the tech world of free thinkers, right? I came from more of a military-esque kind of leadership role company. It was one of the railroads, just to give you some context.
Sure.
But it's been really important. Um, kind of leading people, leading company, a small one that we have, but um, yeah, picking partners is the same thing. And I quite honestly haven't really found a good rubric for picking partners. Just like you just don't know how they are until you go through some tough times with them.
Isn't that the truth?
Yeah, some people say that's I don't know. Some people say that's like, well, how could you not know? It's like, well, you go be a business owner. You tell me if you have business partners. Like you just don't know. It's like, I mean, I think it's harder than marriage to tell, right?
I totally agree with you because when the bullets start flying, you don't know who's going to stay in the foxhole with you and who's going to turn tail and run and say, you're on your own, buddy.
Yeah. Yeah. And we saw this in this like downturn in the market, right? Like yeah, it is like war. I mean, it's like when the house catches on fire, we find out what people do. Do they run in there and help out? Do they freeze with? Do they just stay frozen, or do they run? Right? People do one of three things, and you just don't know how they are. But what's cool is when you go through these shitty times, and this is at least what I tell myself is the one good thing about this is I know who are the people who run in there and grit down. Because the next time this will happen again, right? There will be another market cycle 6 to 12 years later. And at least I know who still has that DNA, who's going to be still around to fight.
Yep, totally agree. So your brand is the Wealth Elevator, and you've got the book. You do a podcast on that. How did that come to be? How did you decide on the Wealth Elevator? And talk a little bit just about how you got it started and where it's at now.
Well, initially the concept was simple passive cash flow because I always thought that this whole thing was it wasn't easy, but it was kind of simple, right? You invest in good deals that you diversify and you pick the best deal that's presented to you and you apply the tax benefits and the infinite bank. It's kind of simple. I mean, once you read the book, right, it is simple, but um the logo was green, it was this kind of lime green, looked like flubber. I got married later and she told me it looked like flubber. I was like, geez, thanks. But anyway, everybody says you gotta use blue or red. So I chose blue, and then the idea of like, there's a lot of financial advice out there, especially in this world of like TikTokers and short YouTube videos. Like there's all these like small short tips, especially financial tips out there. And yeah, some of them are good, but I think the biggest part that was missing is like when did it freaking apply to your situation? And there was never a construct of like, all right, at what point in the net worth levels do these things apply in all the thresholds, right? Investing, taxes, mindset, like it, and that was kind of where I really wanted to differentiate and create paradigms on based on where people were at and start to, write a multi-dimensional book like that. Um, as opposed to just putting out random stuff out there. Like the $5 latte trick that we all know, right? That's the dumbest thing I heard, right? Why would I want to just not have a latte? I'll probably get more energy and ideas out of drinking that damn thing and not wasting my mental bandwidth delaying gratification something so freaking early, right? Like just give me my latte and let me be on my way. But for somebody who doesn't have very much money, that's a great piece of advice, right? On the basement level of the wealth elevator.
Sure.
And there's many other things that are kind of you run through the same lens, and that's kind of where that title or that metaphor came up, and it was that's we got to go with this. It's the brand for the new book, and this is something that we want to this is the message, right? And then it also stands like for what I define as end game $4 to $5 million net worth is that threshold where somebody doesn't even need to invest in real estate or private equity deals. They can just sit on their butt and get the 4% and relax. They could just get that in life insurance. I do think you need to try and expedite getting to that point, but once you're there, you're end game. You're done. Go into cruise control, relax. And so there's a lot of people in our community that are kind of on that level. They just haven't changed their investments to harvest more for cash flow at that point. And I thought that was kind of one of the saddest things because if they were still in hustling mode, saving mode, where they really should have switched to experience harvesting mode a long time ago. And without this idea of different floors of the wealth elevator, they just were running an endless race. I mean, I joke all the time, in our paid mastermind group, which is more for the higher net worth guys out there. But we do these hot seats with people, and it comes up again and again where a guy has ran 37 miles long in a 27-mile long marathon. It's like, where you going, buddy? Should have stopped a while ago. Like you're just doing it because it makes you feel good.
What are you trying to prove here?
Yeah, but it's just, that's just what the sad thing is sometimes people get used to that significance along the way. But if you really have them pause and reflect, they're like, no, I just want to go on a cruise ship and hang out.
Right. Excuse me. Along those same lines, so you had said earlier, um, you'd made a statement like what got you here won't get you there. Have you read that book?
I didn't know there was a book, but I bet there is. But I get the concept.
There is. I read it, and it was an interesting book because it essentially was targeting people who run businesses. And you're a perfect example of this. So you started uh, buying single family houses. Actually, started day trading single family houses, and you kind of kept progressing through the business. If you took the same approach and put a premium on the same things now that you did when you first started buying single family houses, it wouldn't be a very good fit for what you do. But it listed like 27 examples of here's things that you need to change when you are in a leadership role versus an individual role or a middle management role. And one of the things it talked about was there are only four things that motivate people. One of four things motivates people. One is power, one is money, one is recognition, and the other one is popularity. And it's important to know what motivates people because then you can reward them with the things that actually motivate them. And that really resonated with me because, and I don't mean this in like a power hungry way, but I'm almost entirely motivated by power and control. I want to control my own destiny. That's by far the most important thing to me. And that kind of permeates everything in my life. Like politically, I'm uber libertarian. So everyone should keep their hands out of everyone's pockets and everyone should be able to do whatever they want socially, so long as they're not hurting someone else when they do it. And that motivates me from a business perspective because I want to be in control of whatever is happening to me as much as I can be, right? There's some things that are just out of our control. Like you've talked about market corrections. You don't get to choose when the market correction happens. And in your business, it will happen. You said every 6 to 12 years, there's going to be some type of correction. That's just historically, statistically, what happens. So, do you, of those four things, do you notice that one of them drives the people you work with now? Does it drive them more, do you think? Or do you see a diverse group of people in like your mastermind group, in your clients that you work with at the Wealth Elevator?
I think the people that I work with, they're kind of on their way in, right? Like they're still trying to put their oxygen mask on
Mm.
first, even though it might be like a platinum platted mask, right? I would say, what you're saying resonates more with me, and I'm very similar to you, I think, in a way where, what came to mind is like I distilled things down in one or two word values, right? There are like four or five values that each of us have that are probably dominant. For myself, the one that comes to mind is freedom, right? Um, and that kind of governs everything I do. Maybe that's why I didn't want to work at a job. That's why I didn't want to live with my parents in their basement. That's why it's I didn't want to, I wanted to do my own thing, right? So those are kind of the things that I kind of reflect back and maybe help me guide me to where I'm going next is kind of what resonates back with me.
Hmm. Is your wife similar to you? Do you have a lot of similar characteristics or is she different than you?
Very different. That's our good partnership. Yeah.
That's funny. So my wife and I have been together 33 years and we're both very different. At the core, we're very, so like we share core values for sure, but we're very different. She is um very friendly and outgoing. And it's funny to me that I do a podcast like the one that I do that kind of talks about, taking control and dealing with your problems. And it gets into some squishy stuff depending on the guest. Um, like with you, this is a great conversation. I'm glad our listeners are getting all this education about how to think about their financial life and their personal life as well, because you've been very candid about what drove you and et cetera, et cetera. But we have a lot of people that come on that talk about really heavy stuff, losing spouses, losing children, being in abusive relationships, et cetera, et cetera. And like for my wife and I, for me to do this, like you would think my wife would do it because she is a very high emotionally intelligent person. And I've learned to be one from being around her, But left to my own nature, I'm kind of like, hey, quit crying and deal with it, you know?
Yeah. I mean, I'm the same way. I mean, I I did a like a personality test recently. I mean, I'm in a lot of these like business mastermind coaching programs like Vistage and EO. But one of these things, it basically said I was 52% extrovert. So I kind of lied initially, right? I do identify more as an introvert, but apparently I'm 52% extrovert. So our theory, at least my coach told me, is like, yeah, you are actually pretty personable. You have the capability to do it. It's just you just don't like most people. I'm like, you know what? You're probably right. That's why I don't like going to Walmart. I don't like going to the general public, right? Because the general public, 90% of them, 90, I don't even know, a high percentage of people, they don't have the same values as me,
Yeah,
to be honest. They spend their money willy-nilly, you know. They want freedom, but they're not willing to put in the effort for it.
right.
Um, I mean, I think everybody resonates with like you're not gonna go out there and be friendly with everybody. I mean Hawaii's a little bit different, right? Everybody's lives aloha here, but like I think yeah, like I want and that's why like the whole theory is like, well, you only want to talk about money and finances with people. It's like, yeah, I think traditionally, yeah, that's I can see how you say that, but it's there's only certain people with same DNA or values. I don't know what it is that I think, you resonate and you get connection there. Um, so, but I do think that introverted tendencies, they tend to make stronger connections. Like I tend to attract more introverts to our events. And the cool thing there is like once we get people a little loosened up, like the conversations go very deep, you know. And probably some of the deepest conversations that they've had in years, let alone that year.
Mm,
If they just come once. But yeah, I think you that's probably one of the reasons why I started the community and group, right? Like here we are, we're very fortunate. We have $1 million+ technically, right? If you're an accredited investor, you are living life unlike most people out there, and you have somewhat of a responsibility to be a good steward of it, I think, and your kids do too. Um, but you got some friends who aren't into that stuff, and that's cool. I think everybody's good has different friend groups, but obviously finances and financial hacking is like a hobby of mine. So I want to surround myself with similar interests and maybe its values is what it really is.
sure. Yeah, no, makes perfect sense. Have you ever taken Myers-Briggs, the personality test?
Yeah, yeah.
Yeah, it's I've taken that multiple times throughout my career. And the only thing that ever changes is the first letter. So sometimes I'm an INTJ
Oh,
and
interesting.
sometimes I'm an ENTJ. And so what you said made me think of what you said because even though it's very easy for me to relate to people. So it's very easy for me to be on a receiving dock and relate to people that work in a warehouse. And you can take me and put me in a boardroom presenting to a board of directors or a group of executives. And it's very easy for me to fit into that group as well. So I'm a bit of a chameleon when it comes to those social situations. Um, but the way I heard it described was that test really is trying to determine where you get your energy from. Do you get your energy from interacting with other people, or do you get it from being by yourself and planning and thinking and et cetera, et cetera?
Yeah, it depends what kind of people, right? Like,
Ah, exactly.
dumbasses. Nah, it's kind of draining my energy, like, um, but the right people, it's very, very engaging, but it does get tiring. I would say, yeah, it does get tiring too. So,
Yeah. Yeah. I know for me personally, I need a certain amount of time by myself. Like it works out well because my wife actually does as well, even though she's a very social person. She likes alone time as well. And like that's important. I have to have some of that on a regular basis, or if I have to continuously interact with people, it will absolutely drain my battery. Like, hey, I just leave me alone for a while. I'll be out in the woods, or I'll be on a golf course by myself, or I'll be doing something where it's just me with my thoughts.
Yeah. I mean, this is kind of why, I mean, I've heard a rule out there. You never want to go to just an open networking thing because you're finding people on the lower rung and they need to get their own oxygen masks on first. So they're looking out for themselves. But, lately, last several years, I really do enjoy a lot of these like, business owner groups where you have to have a certain barrier to entry, $1 million revenue or greater,
Yep.
something like that. I I do see a lot of alignment in terms of values, delayed gratification, hard work, grit, freedom. It's the DNA of an entrepreneur. And especially I think the first generation entrepreneur too. The ones that are out there, cashing in their 401ks to, power the business, right? Putting it on the line. I think there's no more conviction and demonstration of cojones than that. And investing is kind of the same way too, like I mean, you put the money out there, you never invest money that can't you can't stand to lose, but it's a risk nevertheless. But I think that's kind of where, I found a lot of, social connections lately. And unfortunately, it is a pay to play thing, but I think it's well worth it. In the beginning when I would do this, I've been doing this for almost 10 years now. My wife would say like, why are you paying $40,000 to hang out with these people? It's like, what a loser, right? Like you need friends that badly. But then after a while, I think he gets it, right? He's like, oh, this is a different breed of people. These are like mutants in a way.
She called them mutants, or is that
Well,
just
it's
your term?
that's more my thing, right? Like it's like some of these people are just like relentless, like the honey badger in its way.
But it's funny you say that because I find that anyone that's successful at anything has that characteristic about that particular thing.
There is, right? Successful people who go to college is one thing, and then people who rise to a certain level of their profession, middle management. But then it's just like keeps leveling up like a degree and a degree and a degree
Yep.
from there, right? When you get to people putting 100% of their net worth on the line on this year's budget for their company, and then they got to deal with tariffs, the same thing, something outside of their control,
Mm,
and they still have to suck it up and figure out what's the difference between something in their control and outside their control, so they can focus on something that's in their control and not getting their self sad about things outside of their control that they don't have any control over. Then it's like, it's just there's just less and less people at that point, right?
that's
So
right.
you find typically, not always, but typically when you find people who created their family's wealth, you're working with people who are there for a reason. Yeah, they get lucky here and there for sure, but they're there for a reason. They're not there because of one poker hand or one draw of the cards. It's multiple draws of the cards. So it's just it's a consistent display of their DNA.
Yeah, for sure. Well, and you had talked about it earlier. You had said, there was some luck involved in the timing of when you got started in all this, in that the market was, it was harder to fail in that market, let's say, I think is what I heard you say, from 2009 to whatever, 2018, somewhere in that ballpark, where it was cash flow could be found. It was easier to find cash flow in that market than it is in current market, for example. I went through college on a baseball scholarship, and my first year there, that's a great environment. It's very cutthroat. It's kind of swimming with the sharks. And I got there, and so like you have 25 guys on a roster. and 22 of them dress for road trips. So if you're at home, everybody dresses, but you got to pay for hotels and plane tickets and all the other jazz. So it's 22 for a road series. But there was over 200 guys that showed up to try out for these 25 spots. And so our coach said, "Hey, anyone that if you're a position player, anyone that batted third or fourth on your high school team, stand up." And everybody stood up. And he said, if you were a pitcher and you were the number one or two pitcher in your high school, stand up. And everybody stood up. And he said, your physical advantage that you had at the previous level is gone. Everybody here is as good as you. And the guys that do the work and the guys that learn how to play the right way and are coachable will make it. And the guys that don't won't. And so like that resonated with me right off the bat. Like, hey, I got to knuckle down and bust my ass if I want to make it through this. And I did, but like my first year, actually my second year too. You play the way it works is you go play all fall in these like scrimmage games against a bunch of other guys. And then they make cuts at Christmas and you either make the team or you don't. And if you make the team, you come back and you start the season in January. Well, both of my freshman and sophomore year, all three of my roommates got cut. So I was in living in California. I'm from Portland, Oregon originally, so I would go home for Christmas break, and then I'd have to come back and find somewhere to live because I couldn't afford my rent without roommates. So I had to move and get ready for a baseball season. But like it's a very unforgiving place. You either made it or you didn't, and it wasn't emotional. It wasn't touchy feely. Like coaches don't like cutting guys, but it's pretty straightforward. They hang a roster up, and you're either on the roster or you're not. And if you're not, pack your stuff because we don't need you anymore. And so
Yeah.
I've been able to take that and use that mentality in the real world, and it's served me very well. Like you either make it or you don't. Like you own your own destiny, and if you want to make it, you better put in the work because somebody else is putting in the work. If you don't, you're falling behind.
Yeah. I mean that experience can be like the way I look at that is that gave you confidence that you applied yourself and you were successful. I think that's a big thing that, a lot of people they don't have. They might have had like school is like it's not meant it is cutthroat, but it's sometimes not meant to be outwardly cutthroat as like as you described. So it doesn't put people in a crucible in a way either make it or get out. And in that situation, I think even if people applied themselves and they made it, they wouldn't get the confidence that like whatever barriers or things I face, baseball is baseball, but like as the years go by, business things come up that they don't have confidence to get over whatever barriers come in their way, physical or business related, or even getting a little promotion at job, right? Something as minor as that. I guess I should say, well, maybe major for that individual, right?
Sure. Yeah.
Um, but yeah, I think part of it is like, reflecting on your past is important for that because if you're somebody who just lets these things, you know, yeah, you're a very successful person, but you don't remember it. Um, at some point you're gonna meet something that is an immovable barrier. That if you don't have the confidence or the examples of where these other 4 or 5 times where you were able to overcome because you applied yourself, then you're not going to get over that sixth, seventh, and eighth one. I think that's kind of important. Or, um, I guess that's what journaling is for, right?
Yeah, no, I agree. And we talk about that a lot. Like you have to on our podcast, there's ways to organize your thoughts and kind of overcome self-doubt. Uh, Journaling, meditation, those types of things where you list out pros and cons, wins and losses, feelings, emotions. We talk about like labeling your emotions. Say, I'm feeling anxious. By labeling it, you engage a different part of your brain that is logical. So you get away from the emotion and you can start reasoning through the problem. And one, you've got to acknowledge that it's a problem. Like a lot of people won't do that. A lot of people just won't acknowledge, hey, this is causing me problems. I need to take it on and fix it. They just kind of exist and allow it to continue to happen, you know?
Right, right. And some people call that the devil. Some people just label that as negative mindset. But at some point, successful people get it in their head that that is something upstairs, and there's different devices that, such as you mentioned, labeling it. But you got to get over that barrier in your own head, and because the person who is already succumbs to that negative voice is already going to lose at that point.
That's right. That's exactly right. So what was the decision making process for you to leave your corporate job and go out on your own full time?
Um, well, shoot, I think what I did is I went to a Tony Robbins event. I was not doing mushrooms, but I was surely dancing around a lot, and I was around other free
Is
spirits there.
is mushrooms a big thing at Tony Robbins events?
No, no, but one might think because you walk on the coals and
Yeah.
you just act crazy in those types of things. But I just kind of thought to myself, I mean, at that time we had been syndicating a bunch of deals and I was still working my day job, and I probably could have just hung out of my engineering job, but I was like, well, you seem to be pretty good at this business and you got to pick one or the other. So why don't we make a go at this was kind of the thought. But I think where I was at a disadvantage of, like, the reason why I'm such a good saver is there's some concept of self-preservation that I have and a lot of my investors have, right? We don't want to lose money. But what gets you to the next place, you somewhat have to let go of the side of the pool. I think this is where stupid people sometimes makes for good entrepreneurs because they don't think about the negative consequences before taking a leap. Um, and and this is where I think, unfortunately, for incredibly smart people who overthink things and think of 37 thing that can go wrong, which is an incredibly genius thing to do, oftentimes puts them at a huge disadvantage and they'll never get started. And this can be from selling their house and putting it all into a business franchise or a brand new angel startup, all the way to investing in a little rental property. I mean, like I said, everybody's working on their own demon, some big, some relatively small, but if you haven't, worked on this muscle, it's hard. It's very hard. And I think I was lucky too, because when I first started doing all this stuff, I wasn't married. I didn't have kids. I didn't have, I think that's where it's tough for a lot of my clients, is like, for a lot of them, they've never really done anything like this, or maybe not in the last 20 years. And now they have a spouse, and spouses aren't always, half of them aren't very nice. Actually, probably more than that aren't very nice. Um, and probably second, like, you sure you want to do that? You better not screw up and lose our money. It's like, well, sometimes, you can't determine. I mean, I lost a lot of money these last several years. But that's part of the market cycle in these, right? When the times are good, and you got to make hay, and I made a lot of hay when the times were good. So I eat my own medicine, and then there was a lot of things in there that we learned, that when we look at new deals today, that we know a lot of these lessons are written in blood that have improved our due diligence and what we go into, because of that. And but yeah, I think that's part of why we say, like, one of the rules I tell investors is, like, you never want to invest more than 5-10% of your net worth into any one deal. This is just a good rule of thumb.
Yep.
But you got some of these guys who own an apartment with, they have a net worth of $2 million and $1 million and is in that one family owned apartment. Like, that's not what you should do. That's not diversification, but people do it anyway, right? But by breaking things up, diversifying, you're able to go after these more and more risks. And in a way, very wealthy family offices do the same concept, where they may invest in incredibly risky things like cryptocurrency, altcoins, or angel investments, but they do it with a very controlled portion of their portfolio.
Yeah,
1%.
2% or something.
Yeah,
Yeah, right.
yeah, 1 to
Yep,
5%
right.
or less. Um, but if you're somebody who, we know who are the people who never get anywhere, who are broke, who don't have a net worth more than 2 mil. I mean, you can save your way to 2 mil. It's going to take freaking forever. But, it's kind of like the analogy with swinging a golf club. If you want to hit it farther, you got to loosen the grip.
Hmm.
So counterintuitively, if you want to grow the net worth, um, you got to kind of get it out there. You got to invest, especially in the beginning stages at some point. Now, what I always say is like, well, once you've gotten out there, maybe be conservative at some point, but that's that then again, as we said at the top, financial independence is not for everybody. It's not. Shouldn't be. If not, it's wouldn't be as good when you get it.
Well, there's a lot of people, at least in my opinion, that don't want to or will not do the work or take the risks that are necessary to get there, right? And I mean, so an analogy I always use is just a saying that I heard that resonated with me, but if you want the fruit, you got to go out on the limb to get it. And that's just how it works.
Yeah.
So,
If you don't risk it, no biscuit.
yeah, exactly. And some people just aren't built for that. Some people just don't have the risk tolerance or the bandwidth to kind of understand some of the concepts. But like I agree with you. Like if like Wall Street's a good example, right? So Wall Street uses all sorts of terminology and different things, and they try to make it more complicated so that you think they're the only people in the world that can understand how it works.
Yeah, you're exactly spot on, right? Like they try and make it like, oh, we have all these PhDs on our team. We're smarter than you. But in reality, it's very simple, right? Like I think maybe if anything they have is access
Yeah.
to the deals. But like owning a little single family home rentals, not super complicated. Like people like all my clients are very smart people. They can handle this type of stuff. But where Wall Street wins is when they kind of the marketing overwhelms people and says you're not good enough. Just trust us. Um,
Right. Yeah, which is your first sign never to trust someone. When someone tells you to trust them, don't. Like
yeah. I
trust
mean,
is earned.
I mean, I never say just trust us. I never say there's never any risk in anything. But I guess like the way I take the approach is like, look, hey, here's a sensitivity analysis. In this model, these are the things that could go one way or the other.
Yep.
This is in the realm of possibility, but highly unlikely. And this is kind of the cone of uncertainty in terms of how the outcomes it could be. But again, diversify, diversify, diversify. And if you're going into enough of these good deals, like the weighted average will probably be where you want to be.
Yeah, the math is on your side. I use like a swimming analogy or a drowning analogy. So you could drown in the ocean. You could also drown in the puddle at the end of your driveway in a lot of instances. The odds of you drowning in the ocean are much higher than the odds of drowning in the puddle at the end of your driveway. So the question you've got to ask yourself from a risk assessment perspective is how deep is the water I'm going into? Because it increases the likelihood I could drown the deeper the water gets. So that's and then how strong of a swimmer are you? Right? So like you've got to there's always risk of drowning when there's water. The question is how big is the risk and do you have the tolerance for it?
Yeah, and I also like there's a word called exposure, right? I think most people see that word as like, well, I don't want exposure to risk, losing money. But if you look on the flip side, wherever yin and yang, there's exposure to the upside. So if you were investing in apartments in 2015, you made killings at that time. A lot of deals, maybe you're able to 2x, 3x your money in a short period of time.
Mm,
Um, and maybe again in 2012, right? Just, I mean, kind of anywhere on that time horizon. If you sat out because you found one, two, three things that you just didn't like, or you shot your foot out of the deal, is what they say, um, then you lost out on that upside exposure. Now, I think people need to ask the question. It's like, look, if you're just not going to shoot any arrows and leave it all in your quiver, be okay with where you are at. But if you ask the question, like, are you okay with the status quo? Because we know what's going to happen if you don't shoot any arrows. I mean, if you're okay with that, then that's fine. And maybe they're at a level of enlightenment that I am not, and that's good for them. But I certainly think that, like, I guess that's my philosophy is like, get to that 4 to 5 mil net worth, get to that third floor of the wealth elevator, and then kind of put it into cruise control from there. But unless you get past that point, you're kind of in this like limbo land. Like a few million is not enough to retire. And in a way, gravity is going to keep pulling you down. So, I mean, that's kind of just my perspective on, you need to have exposure to the good and the bad. Unfortunately, people focus on the bad more.
Yeah, right. Um, it's like the age old question, what if something goes wrong? The flip side of that is what if it goes right? But
Yeah.
it's a lot easier to ask the what if it goes wrong.
And you know what's cool? Once you've hit that end game level and you're able to like, you know, tie off the dock, or, if you use the analogy where you're a rock climber, you kind of tie off to a certain checkpoint. Once you get to that third floor of the wealth elevator, now you can kind of try and hit some home runs and for fun, do it for sport. And that's where this investing thing gets really fun. I mean, hopefully it gets fun along that way, or you can enjoy it. But I think that's kind of where a lot of us investors, like, we're kind of like gardeners. We plant the seeds, walk away, maybe water it a little bit. But just, when it finally goes full cycle, 2 years later, 5 years later, maybe 10 years later, and it pops, that's a good feeling, right? You're
Mm.
harvesting the crops. That's something you planted a while ago. Maybe that's how kids are, I guess, same feeling in a way. But I think there's some gratification, from that type of activity.
Yeah, and you talked about it very early on in our conversation that some of the decisions you made were driven largely by money when you first started out in life. And I don't think that's abnormal at all. However, I would argue that when you became the most successful is when you focused on the approach and the consistency, the money follows that. And you wouldn't have gotten to where you're at without the consistency and the approach. And that's something we talk about a lot on our podcast is yes, the result is important. You should be taking actions based on the results that you want, but you can't just focus on the result. You have to focus on the process if you want to get to the result. You got to get the process right. And that's where you spend the most of your time and effort.
Yeah. Yeah, I mean, you're entirely right. It's just it's hard when you're in the thick of things,
Is
right?
it?
When your ass is on the line, you got money going up in smoke. That's when it's hardest to be in conviction of this,
Yep.
you know. Um,
Yep, for sure.
It's easy to play when you got a 20-point lead. It's hard when you're 4 points down going 2 minutes into the fourth, right?
Exactly. You're in the 2 minute drill. And yeah, look, people, in my sports life, I was always a good defender because I'm pretty good at applying pressure, and people make mistakes when they're under pressure, and that's what I was really good at two sports. I was really good at baseball. I was really good at soccer, believe it or not. And I always explain to people in soccer, look, it's just a game of time and space. On offense, you're trying to create time and space, and on defense, you're trying to eliminate time and space. So there's some basic things you can do. Most people are stronger with their right foot. So if you want to eliminate someone's time and space, show them to their left so they have to use their left foot and then increase the pressure on them. Push them towards the sideline. Now you've got them on their left foot with a limited amount of space and you're on them. They're going to make a mistake. That's just how it works. And it's very similar in life, right? So you talked about not being able to predict what partners were going to do until you go through a couple of tough things with them. And that like nothing could be further from the truth or nothing could be closer to the truth. I mean, it's 100% correct. When you put people under pressure, you just don't know how they're going to react.
Yeah, yeah, but maybe the to have a caveat there is to protect against like the downside, the failure that totally knocks you out,
Yeah, for sure.
right? I don't know how that really applies, but I'm thinking like, you got wealthy kids, keep them away from the crack cocaine, right? Like time and pressure, space, I got it, but keep them away from the crack cocaine, right? Because that's something that can take them down that bad path, right? I mean, kind of jokingly, right? But that is an example of something that can totally take you out.
Yes,
Um,
immediately.
yeah. Whereas you're making some bad investments here, there, you should be able to sustain that. And, if you, especially if your portfolio is diversified over 4 to 7 years or greater, you'll survive. But certain decisions out there are, you know, much more detrimental or higher leverage to the downside. And maybe the question is just don't make those mistakes. As it kind of goes into, you know, risk is one of these things that it's hard for people to quantify or make decisions off of, especially when they're unaccustomed to do it. Um, you have a lot of poker players who are able to, calculate the percentages of things right to the percentage, right? They may not be able to do that in real life application other than silly cards,
Mm,
but in certain things in real life, there are, just not good odds. Obviously, you stay away from those, but certain things that have a huge downside that you just don't even play in that arena.
yeah. Yep. Charlie Munger, Warren Buffett's buddy, recently passed away. I listened to a talk from him one time, and he said he got his start in the world as um, essentially like an air traffic controller for military missions. And so he would draw out the missions and kind of coordinate those things. And he said one of the first step was always, what could I do that would get these guys killed so they didn't come back? Because he said I wanted to identify it so I could avoid it. Like
Yeah,
my whole mission was based on avoiding that because that was certain death for my guys, and I had no interest in exposing them to that type of risk.
yeah.
And he
It's
took
like the Apollo 13 movie where the guy's like puts that masking tape and don't fucking press that button, right? Like,
exactly. Yes, that's exactly right. And then he applied that in his investing life too. What could I do that would just blow this whole thing up? So I'm going to avoid that. And then I'm going to take acceptable levels of risk from there. Right. So that always made a lot of sense to me. I thought it was, a really basic, but really intelligent approach.
yeah, yeah. Or another way to apply that is what is something I'm gonna take as much risk as I can, assuming that with more risk comes with more equal reward, right? Certain things don't really follow the one-to-one or the Sharpe ratio is this concept, right? For
Hmm,
2 units of risk, you should have 2 units of possible reward, right?
sure.
Shouldn't be out of whack. But certain things like skydiving, I would never go skydiving
Me
because what's
neither.
the worst that can happen? I mean, you can't live with that. I die, right? Um, but like in investing, it's kind of like, well, what's the worst that can happen here? Well, that thing goes to zero. I mean, that's the nice thing about being a passive investor is like your kind of downside is somewhat protected, right? You're not the one signing on the debt. If when you are owner of a single family home rental property, yeah, you can lose that all that down payment, but you can also get sued for more on top of that,
Sure.
right? So your exposure is greater than that. Um, but yeah, there's certain I think if people use that tool, right? Like ask yourself, whatever you're going to do, even outside of investing, right? Like what's the most riskiest thing that I can do? Because sometimes risk comes with fun, right? Enjoyment. I want to go take a trip to here, like, well, that might be tiring, that what's the worst that can happen? Well, I get tired. Somebody steals my wallet. there. Can you live with that? Yeah, do it. You
Right.
know, yeah. Like, will I go to Egypt and go into one of those shady tourist places to try to save a few bucks? What's the worst can happen? They kidnap me? No, I don't want to do that. Let's not do that. Decision made.
Yeah,
Let's just pay a few more bucks.
I'm not staying in a hostel. I'll go ahead and head down to the Holiday Inn. Thank you very much.
Right. Right. But in a way, going back to your time and space, like if you're able to expedite these decisions, I think that's a problem that I see with a lot of inexperienced investors who typically don't have very much money. One of the reasons why they're there is because they just don't freaking come to decisions. They're in analysis paralysis mode.
Mm,
They've in a way, and I use this analogy a lot for like investors, and it's like when you're on the first floor of the wealth elevators, just go around the freaking board and buy stuff, right? Is the monopoly strategy. Right. I think we can all agree that's the strategy of monopoly. As long as it's not those crappy like Baltic Avenue ones, buy the damn thing and keep
Marvin
buying
Garden.
things until you keep going around, until you start to cluster your properties, right? In a way, that's kind of where I was in the like first rung of the wealth elevator. Just go around, buy stuff that makes sense. And then we can kind of talk about consolidating, getting more strategic. And at that point, you learn more. Right? Part of this is all learnings. I follow the 70-20-10 rule. 10% is academic learning. That's where my book comes in. 20% is more the peer group. That's why we do community stuff in our group. But 70% of it is just doing stuff and messing up and learning. And, like my first few rental properties, probably the wrong rentals, but you know what? I just moved on and it got better and better and better. We've made mistakes over the years, um, learned from it. That's just made us better investors today. Um, and I think that's kind of where, just iterations. And if you're somebody who's always in analysis paralysis, you just don't get the the reps. And part of this is practice.
For sure. Totally agree. And look, again, pointing out themes here. So you got to do the work. You got to learn from your mistakes. You got to persevere, right? We talk about that a lot on the podcast. So you got someone here who's walking you through their experiences, who's been both financially and personally pretty successful. So it's not just us saying it. We didn't revolutionize thought leadership and come up with these things. This is what you see and hear successful people talk about over and over and over again. You have to take your shots. They're not all going to land. You have to learn from your mistakes. You have to persevere and you have to make iterations and adjustments and apply those learnings to future endeavors. So the formula is not complicated, not easy, but it's not complicated. But you
Yeah.
got to be willing to get off your ass and take a shot too.
Yeah. Yeah. Take multiple shots, as many shots as you can. Just avoid the death shot on you. Right? That's the takeaway.
Oh, that's awesome. Well, so I always do this at the end. Is there anything with all guests? Is there anything we have not talked about that you think is important that you want to leave the audience with? And if there is nothing, that's fine. I would just try to open the floor for our guest to cover something in case I missed it, because I'm certainly not all knowing.
No, you got all the things I talk about today. Thank you. Great podcast host. I don't think I've ever gotten this depth. Um, I think the one thing, if I were to share some of the lessons from some of my more higher end clients, is it I think in the beginning you go through this phase of putting your own oxygen mask on financially, but at some point, like I said, around 4 to 5 million net worth, you start to realize that you need to go after and spend your money for experiences. The quicker you can do it, the quicker you can start to live your life when you don't have to trade time for dollars. And that's the inflection point when you don't have to trade time for dollars. And that's what passive income does. Um, but that's unfortunately a lot of people never get there. Um, but yeah, I'd say, you guys may be there, check out my book, The Wealth Elevator on Amazon. If you guys want a free electronic copy, shoot a team an email, team@thewealthelevator.com. Tell tell them you sat to the 2 hour long salty ginger episode. And I think yeah, I think what's cool about this and the where the analogy of the wealth elevator comes full cycle is we always tell people in our community, well, you were new at this as I was at myself, and you send the elevator back down for somebody else, somebody who has the cojones to try to take some shots and do something about it, right? But there's a lot of, and that was kind of my whole thing is like there's a lot of people that worked really hard, go to college, are great contributors to society. They also pay a shit ton of taxes too. My goodness. And they're just unfortunately going to be stuck in the grind if they keep doing things the traditional way that Wall Street wants them to do. If this stuff isn't a get rich quick scheme, but if they do things a little bit differently, they can get back a decade or two of their life and totally transcend the trajectory of their family. But yeah, thanks for having me. Appreciate it.
Thanks for coming on. I call it a get rich slow scheme. That's what I call actual wealth building. It's a get rich slow scheme. Like
Yep.
there's nothing wrong with that. That's how most people do it. So
Yeah.
yeah. Well, Lane, thanks so much. Really appreciate you taking the time. I know that you have an impending addition to your family coming. I hope everything goes well for your wife and during the delivery. And we're going to post the Wealth Elevator information in the show notes so you guys know how to go check out Lane's book, Lane's podcast, Lane's mastermind groups, et cetera, et cetera. So if you're so inclined, you can get in touch with them. And Lane, thank you so much. Really appreciate you coming on the show.
Cool. No, thanks for having me.
All right.
Okay, bye.
Have a great night. Guys, like I can't even I don't even have words to describe what a great episode that was. So Lane was very forthright, talked about his experiences, talked about what led him to take the actions that he took. Not everything has gone perfectly for him. He learned lessons, he lost money at some points. However, he was smart and didn't put all of his eggs in one basket, diversified, and was able to weather the storm when the seas got choppy. He has a website that allows you to understand a lot of what he's talking about at no charge, by the way. We've got show notes that have the link to his book. We have show notes that have a link to his podcast. And I'm just really fortunate that he joined us. Thought it was a great conversation and he did a great job, even though he said he was an introvert, but actually wound up being an extrovert. So really appreciate him coming on the channel. That's it for this episode, guys. Don't forget to head over to our website, saltygingertalk.com. Jane puts it up right over here every day. We've got all of our podcast episodes available there. We've got links to our social media accounts there. We publish a newsletter every weekday you can subscribe to there. And we really appreciate you checking out the channel. Please, please, please like, comment, share, subscribe to our podcast on whatever platform you consume it on. Really appreciate you checking it out. Super episode. We're going to continue to bring you awesome guests like Lane going forward. So don't make sure you subscribe so you don't miss them. Thanks a lot, guys. We'll see you on the next episode.